in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. My name's Mark Todd. I'm from FIG Securities. If you have any questions, please pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. And joining me on the panel tonight is Roger Bridges. He is Head of Fixed Income at Tyndall AM, and Francesco Distratus, who is an investment advisor at Ord Minnett. Gentlemen, welcome. How are you?
Thank you, Mark.
Well, thanks, Mark.
How was your week? The week that was in the volatile world?
Week.
Yeah. How was it?
We were prepared for it, something like this to happen. We had actually had our Global Investment Committee last week, and actually we're looking possibly have an early tapering, and we're prepared for the announcement on the FOMC on Wednesday night.
When you have an investment committee that works that out, what do you do in respect of, I think Bernanke's going to say boo? How do you manage that? Is it you just start to get short, you start to look to sell and say take some protection, or do you just say we're going to be ready, willing, and able after the event? I mean, what do you do?
That's an interesting question, because with the quantitative easing we've seen, a lot of the markets have behaved very differently to what we've seen in the past. So what we did was just dial down the risk and actually just go in slightly short, thinking the Australian yield curve would steepen, so we put those positions on, but didn't really want a lot of risk on, particularly in the bonds.
And for steepening, what you're saying for the viewers at home is that the long end is if it was at 3.2% interest rates, it'll go to 3.4, 3.6. That's the sort of thing.
Yes, the 10-year rate has gone up to around 90 basis points over the 3-year rate, and that's pretty steep for our curve.
That's elevated.
And you think in the US that could be up to 170. So it's a lot. It has steepened quite a lot from the 40 basis points that we've been used to.
Right. And how was your week, mate?
My week was pretty good, except for last night.
Today. Did you kick the cat? What happened?
It depends on the clients, but look, the market's performed quite well over the last 12 months. We're still much higher than we were back in the depths of August last year, and the sentiment built into the market back in July and August last year was quite awful to the point where no one wanted to do anything. Last night's fall in the US. Some people hit the panic button. Some people see it as an opportunity. I think it was a bit of a knee-jerk reaction. If Bernanke's talking about easing back on the pedal, ultimately that's an indication that they think the US economy is performing okay or improving, which from a equities point of view, that means businesses should be profitable again. So I wouldn't be overly concerned. There are a couple of things in the back of people's minds that you're sort of always wary of, but from our point of view, we've been sort of taking a US dollar sort of investment bent, if you like, so companies that are earning a bit of US dollar there. Not that we expected the US dollar to come off as much as it has over the last couple of weeks, but it's certainly paid off. But I think that theme might continue a little bit longer.
I suppose the thing with the Bernanke commentary was, to Roger's point, it's very hard to trade. And what Bernanke actually said is that we'll consider it, and this is the timeline in which we think we'll start to consider it in the event that wheel kept working. And that's the $64 question. It's the working wheel of the US economy. And so now the currency is much higher. We'll do it on the basis, we'll ease on the basis that employment goes up. Now, I can assure you, you could ring anyone in the United States and say, if you had a job in 2008, have you had a pay rise since then? And they will say no. And if that employment goes to 6, I can ring them the next week and say, are you asking for a pay rise? And they will say yes. So I would assume that what that'll do is make American corporates less profitable. The jobless recovery becomes a job wage growth. I mean, is that just a completely axiometric concept?
I think we've got to realise that what Bernanke's saying, this great experiment we've had, he's still keeping interest rates at zero. All he's saying is that I'm looking to pull back at 7%. He's actually not done nothing.
Yeah.
But what's happened is the hedge funds have actually gone, this we can see an end.
This is an opportunity.
And, well, not an opportunity, they may have the wrong positions. And so what they've done is started unwinding. And I think we're just seeing the beginning of an unwind trade more than anything else.
How long does this last? How's the volatility play out? What's your anticipation? Do you think it's a 1 week and then everyone will calm down? Bernanke hasn't actually done anything. He's still
That's exactly right.
85 billion every month.
Yeah, well, I mean, I look at things like you talk about profitability of companies, and you go back to the GFC. A lot of companies fixed up their balance sheets, put their costs back into line. A lot of cost-cutting programs have been put in place over the last 4 years, not only in the US but here in Australia as well. So you mentioned, sort of wage rises. I think that's not on the cards for a little while until you start to see that unemployment number come well down below 7 and even in below 6 maybe even. But that makes companies profitable until that wage pressure starts to go up. And because they're more flexible in the US, I don't think we'll see that for some time. The other thing you have to consider there is, okay, the currency's moved against them from a point of view of exporting, but at the same time it's still fairly weak historically over a long period of time. So whilst buying things in the US aren't as attractive as they have been in the last sort of 12 months, over the longer period of time they still are quite attractive.
Francesco, I can promise you the currency is going to get absolutely crushed because my wife has just decided we're going to the States for a holiday. So I can promise you that the Aussie will completely plummet and I'll be paying through the nose. It's one of those things. It's just a fact of life.
What happened to my sister when she went back in 2009, I think it was 2008, the Aussie dollar sort of started to rally, and then just at the time she decided she went back down to sort of 75, 80 cents.
But I think you've got to also understand that everyone looks against the US dollar.
Yeah.
And yes, we've gone down. But against other currencies, yes, we've gone down, but not as much. So we're probably at levels that we saw last year.
Yeah.
Well, the trade weighted index is only down about 7%, something like that.
Which is interesting because the key to it is that we think, as a country, our reserve is saying there'll be other sectors will take over from the mining boom. And to your point, if the trade weighted index is not down enough, then who are the trading partners that will take advantage of our lower currency? It's the United States, and then it sort of weakens away a little bit.
And it's only just happened as well. So we were up to 100 yen at one stage, and now we're down to 90. And they're our second biggest customers. So, we've only come down to something which we were last year, and we were still screaming then. So
absolutely,
it's not that it's just against the US dollar.
And if you were a car manufacturer in Geelong, you'd say, look, at 85 cents, it's still not even close. It's just not going to work.
I believe our equity teams thinks the break-even's around 81, so it's got a long way to go.
Yeah. What do you mean by the break-even? What do you mean for the viewers at home? What do you mean by that?
Well, they sort of think that 81 cents is where the economy may start picking up from. So it's still, we're a long way from that.
It's interesting. I was reading some reports today about a 5% change in our currency is worth a 25% change in the cash rate. So that was just what some economists were saying as a rule of thumb. So in effect, we've had 3 price cuts over the latest movement. I don't know if that's going to be accurate. I think they can talk to anything. The economists can say anything they like. But in terms of your economists and the views that you guys have got coming through, how vibrant do you hear that the United States is? What do you think it's as strong as Bernanke is suggesting?
We're fairly confident on the US, but you're only talking about growth around 2%. They've still got a long way to go. What's happened is that last year they were worried about stalling and we get deflation and the whole economy would get worse. Now they think that they've got enough speed to keep on going, but that speed's probably not fast enough.
What about you guys?
Well, we don't think the US economy is booming along, but it hasn't put in any numbers above trend since before the GFC. So, you know, and Bernanke the other night pulled back his numbers a bit from 2.3, between 2.3 2.8, I think it was. He's narrowed that gap from 2.3 to 2.6, so his upper end of the range has come back a bit. So he's not expecting that economy to be booming. He's just hoping that it'll continue that, you know, growth at some sort of level that's close to trend. Now, if it gets above trend, then you might have problems with inflation, but I don't see that as a major issue in the short term.
Europe? I mean, what's the sentiment
Basket
there?
case.
Basket case. Take
I
years.
agree. I agree there.
You know, you've got that very subtle English accent. What about the UK?
Well, the UK, the problem is the UK. Its main market is Europe. So whatever Europe does affects the UK.
It's so funny how the politicians in Britain don't seem to get that, where they say, well, let's have a vote on whether we should be part of the European Union. And the European Union would be looking around saying, at the moment we've got enough problems. You could move on a bit.
I think that's been a long-term political problem ever since Margaret Thatcher. So, it still will keep on boiling over, I think.
I suppose it's like that. Anything, all politics is local, so it's everyone just appealing to their constituency. But they know that they've got to sell product into the UK, whether it be, you know, really bad beer or, you know, whatever.
Whatever it is.
Look, we'll have to go to a short break, but please feel free to give us a call on 1300 30 34 35 for any questions you have on investing, and the email is yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. Tonight I'm joined by Roger Bridges, who is Head of Fixed Income at Tyndall AM, and Francesco Distratus, who is the Investment Advisor at Ord Minnett. They're here to answer any of your questions tonight, so feel free to pick up the phone on 1300 30 34 35 and the email yourmoney@skynews.com.au. And we'll go to our first email for the night, and this comes from Kyle in Manly, and he writes, I only hold equities, and this market movement has hurt me again. What has happened in the bond market? Kyle, the first thing you need to do is buy some fixed income, because that will...
Diversification is...
You know, it's the $64 question. Yeah. Everyone is long the equities or long equities in cash, and that the volatility hurts them, and then they turn around and say, now, remind me what that fixed income piece was supposed to do. I'm a little bit at a loss. And I would have thought, we'll go to Kyle's email, obviously, but with odds, you know, I've noticed that you guys buy more fixed income. It's becoming more of the vernacular, isn't it? Everyone.
Yeah, well, since the GFC, we set up a fixed income desk.
Yep.
Yeah, we're not as specialists as Roger here, but yeah, we offer clients, you know, a holistic wealth management process where we look at not only, you know, investing in the equity markets, which is, you know, what we're really known for, but also, you know, giving people, you know, diversification across asset classes, and that's not only you know, equities and fixed income, but it's also things like, you know, property trusts and the like, you know, even to the point where, you know, the market now, which I mean the ASX, offers listed ETFs which you can get exposure to commodities and currencies as well. So getting that broader diversified approach, I think will take a little bit of volatility out of Kyle's portfolio. So he probably should look at weighting some of his investments across into some fixed interest and that area.
Yeah.
I don't disagree with that at all. I mean, if it hadn't been for Bernanke last night, the equity market could have sold off because of what's going on in China, and the bond market would have rallied. It's just because Bernanke's talking about stop buying bonds that the bond market sold off. But there's going to be a natural level where people are going to say, well,
that's
good value. At the same time, I can't rule out further rate cuts here, even with the currency coming
Actually, we've got to talk about that. We'll talk about that a little bit. But you did say something that was very interesting. China. It's the shadow banking. It's the one-party performance. You as the voter, I need to keep you happy because we've only got the one party. It's the whole problems that we all understand. How do you think they're going about it? Because it seems to me that they really want to get this shadow banking segment organised. They want to move it out of the system. there's challenges in that, isn't there?
There's a debt problem in China like there was in the US, and the shadow banking just reflects how they tried to, it really is about them controlling interest rates, and so people to get higher rates started lending elsewhere, so you could form this shadow banking, and that's an issue, and it's very much like the US 5 years ago.
So it's unregulated. The shadow banking in itself, as a description, is an unregulated banking sector. In other words, I'm saying I'm lending to you and you, but in point of fact, you're actually lending to the bloke down the street and he's putting it into property. And you're saying I'm actually the borrower, but you really moved the money on and he bought it, and that's the shadow banking sector, and that's the problem, isn't it?
It's very similar to what happened here when you had the finance companies. You know, you were controlled, and suddenly the finance companies started falling over because
the Sanders started throwing money at everyone.
Exactly right. And
the checks and balances aren't there when you got sort of looser intermediaries, I would suggest, than say the regulated ones.
Yeah, that's right. And so that then becomes. What happened yesterday was the suggestion that the Central Bank of China was not going to lend money to the system, and so repurchase rates went up very high. They went up to 13 14%. So for the viewers at home, people were looking to borrow money, and the cost of the funds to borrow money in China became 13 and 14% for 1 week and 2 week money. And that spooked markets. They thought that was going to create a crisis in the Chinese sector, and that would feed into the rest of the markets. That was part of the reason we thought there was a sell-off in equities. That was part of the reason that we said there's this volatility.
And the world's becoming multipolar, and it's just not. You can't just watch the US or something. You've got to watch everything at the moment, and it's having different impacts on markets.
A lot of economies aren't working in sync like they used to. So normally when the US would start growing, the Australian economy would do well. But the Australian economy's gone a bit out of whack because of the Chinese stimulus back in 2008, which propped our economy up. Now we're some of the economists around town, and I don't disagree with them, are suggesting we might be looking at a short recession next year. Nothing to what Europe's going through or anything like that. And look, I can't argue against some of those forecasts, but what the Reserve Bank is trying to do is shift some of that stimulus from capital expenditure in the mining sector across into construction, and there's a bit of a lag happening, and it doesn't appear to be shifting too quickly, and that's the concern we're seeing locally as far as the economy here.
We had a chart last week, and what it tried to show was the movements in the currency versus the interest rates. So interest rates were coming down dramatically, and the currency was not budging. It was just staying. And the point we're trying to make was the regulator is finding it very hard to affect the policy that it had traditionally done. I'll drop interest rates, currency would drop, I have cause and effect, I understand what's happening. It wasn't happening.
Well, the currency changed, particularly in 2010, 2011, because of our AAA rating, liquid bond market, which we hadn't had before in the last 10 years, and people wanted flight to safety, so they piled into here. We had 90% of our bonds held, federal bonds held offshore. Central banks came in here, and that kept the currency up, and people thought that the currency, and so it lost its relationship to commodities. It's only just got it back, but really is about concerns around China than commodities.
That's right. China's the big story for all the people at the moment, whether they realise it or not. It's the Chinese story. Let's shift gears a little bit, because we're about to go to a break soon, and you're going to give me Speaker's Corner, Francesco, so you can think about that one. But tell me about Tyndall AM, Tyndall in the morning. What's Tyndall AM?
Well, your viewers, Tyndall AM used to be Tyndall Investment Management, and we were bought 3 years ago by Nikko AM, which is a very large Japanese asset management house. It's trying to grow around Asia. It's got around 6 offices there, plus what it wants to do is actually buying us to take our product to Asia and also take their product from Asia back to here. So given that Australia is sophisticated but also very tied into Asia. It really means that what we're offering is that ability to know about Asia as an asset management house, and so we're very connected to Asia, and ever a lot more than we were, and so therefore there's a real big benefit to our clients.
It's an interesting thing because I completely understand the premise that you're making. The Australian market, and Francesco, you could probably have thought in this, it's much more sophisticated than you'd imagine for its size. So you can get people that have traded an array of different products that work in the one organisation, and then they'll be able to take that experience out to the rest of the world. In the United States, it's so centralised. You could trade one part of the curve, 0 to 3 years, and you wouldn't know anything about 4 years. Whereas here, it's quite different, isn't it?
Yeah, well, I mean, I specialise in equity, so it's a bit hard for me to comment on the bond market. But I mean, just looking at what I
know nothing about equities, so I still comment, so don't worry about it.
Well, I mean, just look at the Australian Stock Exchange now, and I mentioned earlier the products they're releasing. Just recently, you can get onto the government bond market now, just listed through the ASX. So retail investors, particularly getting more access to more sophisticated products that they wouldn't have got access to in the past. Even corporate bonds, previously over the counter, minimum $500,000. Now you can buy subordinated notes, which are pretty much the same, if you like, in the likes of the banks and your Tabcorps and things like that. So I think the availability of and the access that retail investors are getting are becoming more sophisticated. Yes,
and the impact of the we need to talk about it after the break, but the Japanese impact on our markets, it's quite significant, isn't it, in terms of as investor bases?
Well, some people think that something like a quarter of the CBA register is owned by the Japanese. I'm not too sure what that's true, but they've been a very heavy investor into Australia, and part of the sell-off was because the yen went up to 100 and they took profit, and so we saw certain types of securities where they invested.
CBA 73 down to 66.
Yeah.
Look, we're going to have to leave it there, but we'll go to a quick break. But before we do that, it's time to crank up the speed clock for Speaker's Corner. And Francesco, your first cab off the rank. You have 30 seconds, and it starts now.
Okay, the themes we're looking at Ord Minnett at the moment are particularly looking at the stocks that have got US dollar earnings. I mentioned that a bit earlier. With the currency starting to weaken here in Australia, companies like Amcor, Ansell, QBE, ResMed, CSL, Brambles, all with large amounts of US dollar earnings, will start to reap the rewards of that adjustment in the currency, as opposed to what happened to them about 4 or 5 years ago when the currency started to appreciate. The other area we were looking at a good theme is LNG.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIG Securities, and we have our first caller of the night. It's Brett from Sydney. He'd like to talk about the US bond market. Hello, Brett. How are you?
Good, thank you. Just have a general question in relation to the US bond market, how they consider it's kind of heading in bubble territory, and the Fed tapering is going to maybe initiate some sell-off, which is going to gain some traction. I'm just concerned with my kind of fixed income component of super, and a bit worried I'm going to lose capital in this fixed income component, and whether I should reduce exposure. Is that correct, or have I got this wrong with the fixed income component of super?
I suppose the first question I need to understand is do you know the portion that you've got of your fixed income of your total portfolio? Is it a 20% allocation? Is it 10, or is it 50 or 70? So I suppose that's the key to making those assumptions at the moment. So I don't know if you're still with us there, Brett, to answer that question. Seems he's gone. Do you want to talk me through?
Well, the big question here, how you will lose capital or have a capital loss. Fixed income, unlike equities, pays a given income, a coupon, and so therefore time's a very important issue here. If it happens quickly and keeps on going, yes, you lose money. But if it happens slowly and the income effect will start offsetting that capital effect. And we haven't seen since 1994, in fact, the bond market have a negative return. And most times interest rates have gone up in 2002, 2003. In fact, the returns have been low, but they haven't been negative.
Yeah.
And that's because rates have gone up slowly. And given that Australia really still doesn't need higher interest rates, it's very unlikely we will see negative returns in Australia.
And I think for Brett, particularly if you're talking about the US market and its relationship with the Australian market, that they do decouple, and it's around the question of one thing is who's your fund manager, where have you got those fixed income assets, which assets have you got. We saw in the last week or so Rio came out with a bond issue, snapped up. Everyone wanted more of it. They wanted 5 years. The problem with the bond market is there's not enough bonds. So in the event there's a sell-off, there'll be lots of people looking to buy those bonds. It's the Australian market is recalibrating because 70-30 used to be the form. Now if you can get really good corporate bonds, people will put that into their portfolio with a 5, a 6 and a 7% return, and then use the 70% left to have a crack at Rio or BHP.
I think you also got to remember the US sell-off, unlike other times, is actually being due to real rates, not because of inflation concerns.
Yeah, that's right.
And that may actually stop the sell-off in its tracks if inflation doesn't take off, because people say, well, I would like bonds. And we're only just above that sort of period where it could actually tilt to either inflation or even deflation.
Yeah, that's right. That's the concern, that deflation.
Back into bonds, everybody will rush.
Everyone will rush like there's no tomorrow. And it's I look at the RBS note every morning, and they are talking about the amount of money that's still sitting on the sideline waiting for that bond sell-off that I'm ready to pounce. I really want to get those bonds at whatever rate in the 10s and the 30s in the United States. And it's interesting that a lot of money sits on the sideline waiting to get that better yield because they think it'll come back. It's got to go somewhere. They're getting zero
and the
on the
cash
short
rate
cash.
is still zero.
They're getting zero in the cash rates, and Bernanke is not going to let rates go up. It's just he can't afford to because he got it right. He got it right that it was in the construction piece. So he's got to keep those rates low. US 30 years mortgage is 3%.
And I think that's the one thing we forget. Here, the mortgage rate's tied to the cash rate.
Yeah.
There, it's the 30-year rate.
It's the 30-year rate. You go to the United States, get a 30-year rate. I rang a mate of mine in the United States, and I said, what's your mortgage rate? And it was 3 something. I said, it's so rude. You don't even know the number now. It's just 3 something. Give me a break. Look, it's time for another email, and that email comes from Henry in Melbourne, and he asks, it's consistent, if we have high interest rates, what will the effect on dividend yields? So what will be the effect on dividend yields? So maybe that's for you.
Well, I suppose, if you look at dividend yields, you're looking at a number of moving parts. Obviously, the earnings from the company and the price of the shares. So rates going up, economic theory says, the stock market comes back. And in effect, that should put your yields up a bit. But ultimately, also, if the company's got a level of borrowing, it reduces their profitability. I think probably what you more should be looking at is if rates come up a bit, what your focus is on is in your equity portfolio. We've seen over the last sort of almost 12 months now a lot of money flooding into the equity market just looking for yield because your term deposits were giving you nothing almost, and the bonds giving you not a lot either. So I think when you see a more attractive yield in term deposits in the bond market, then you'll see some money coming back out of there out of equities back into bonds. And ultimately, when the share prices come back, as long as that profitability stays there, it actually improves the yield somewhat. But you've got to have that balance.
Yeah, I suppose it's a function of, with Bernanke moving back, there might be more. There's less crowding out. There's a re-rating of risk, if you like. What should an equity produce versus a term deposit? A term deposit's 4 and equity's 6. Is that the right mix, or is it more like equity should be at 8 and term deposits at 4? Right?
I'd also say some of the models of valuing equities have been thrown out because of the low real rate or risk-free rate.
Risk-free rate
from the bond market, and it's very hard to value what really should equities be if you don't really have a true risk-free rate.
So when you talk about risk-free rates for the viewers at home, you're talking about a government, a sovereign, and the price at which they issue the coupon you get. That's the risk-free. That's because they can print money and they can give it to you.
And if the central bank's in there intervening, keeping it down, well, how do you judge risk and where it should be valued? So it does cause issues.
Yeah, I worked for a fellow called Terry Smith, who is a colourful character, and he would price it on what he thought the sovereign should be. He didn't care where people paid. He just said, I think it should be at 5% or 4%. He had his own, nuance about where he said, and he's now got about $1.25 billion sterling in his fund. Because he's just said, I just don't agree on these rates, and everyone's just given him money. It's quite interesting how he...
say that, because I always say whenever people ask me about what's going to happen, every first Tuesday of the month, what is the Reserve Bank going to do? And there's two questions really. What is the Reserve Bank going to do, and what should they do?
Yeah.
Because they don't necessarily do what they should. But that being said, over a long period of time, they've done a pretty good job.
Right.
But
I think they've done a good job in hard times. It's been, as the whole world's delevered and everyone's... The thing that's been interesting is they've got the consumer so wrong. They haven't been able to get the consumer to act, and the consumer's just saved. I'll give you cheaper money, spend it. No thanks.
I don't think that's the Reserve Bank's getting it wrong. It was probably more of a misperception of what people will do when rates are there, particularly after the GFC. Emotions are driving what people do in markets.
I guess it's probably, I'm thinking more about the last couple of years where they've been incrementally cutting these things and saying, well, people are spending their money when in point of fact they probably weren't. But we can talk about that after the break. We are going to go to another break, and before we go, it's time to crank up the clock. Now, Roger, you've got Speaker's Corner. You've got 30 seconds to tell us what strategy's on your mind. Time starts now.
What I'd like to talk about is human-centric we are so much at the moment. I remember driving home, and on the radio was talking about how in the past we used to think everything was due to us, and we've got rid of that. And now what's happened is that we keep on intervening, and I think we need to stop it.
As in the QE, you're happy to get...
Quantitative easing is a classic example of that.
After the break. Welcome back to Your Money, Your Call. I'm Mark Todd, and just a reminder, if you have any questions on the share or bond market, pick up the phone and give us a call on 1300 30 34 35, and the email yourmoney@skynews.com.au. Before the break, we were talking about the QE, and you don't like it, and the interventionist world. Can you give the viewers an idea on the Japanese investor? We talked about buying CBA and being a large percentage of the CBA piece, but what happens in the bond market? Let's go through. What will a Japanese bond investor buy in Australia?
Well, the Japanese bond investor, you got to remember, he had very low yields. He looked at Australia and was seeing 300 or 3% over or 4% over. If he went into a state government, it would be even higher. So they tended to go for the AAA type names, state governments like New South Wales, or when it was AAA, Queensland.
Sorry for the folks in Queensland, you're not AAA anymore, but after state of origin, maybe.
Maybe.
Who knows?
But the other names is things like foreign issuers who were called supranationals or agency. Names like the World Bank. Names like some of the European sovereign names, EIB, and they issue down here, and they saw those a lot. And when the currency went up to around 100 yen, they actually sold, and we saw them start blowing out a little bit.
So the World Bank will come into the over-the-counter Australian bond market, and it'll issue bonds, and Tender will buy some, and everyone will buy some in their name. Fund manager.
Exactly right.
The Japanese customer acquires these bonds via you. He doesn't hedge this up. He generally doesn't hedge this up, or
we actually issued a bond fund in Japan where there is a hedge. In fact, we were very lucky that it's run out of Tokyo. They actually put the hedge on at 97 and just taken off at 89. So it actually did better than probably other people who weren't hedged. But they were started getting concerned when the yen dived and our currency went up. But generally they were unhedged.
How does people get money to Tyndall? It's not just Japanese money though, is it? There's other platforms which if the viewers at home like Roger, they could go and give you money, but they don't. It's not a brown paper bag. How do they get money to Tyndall?
Our actual bond funds actually on over 30
platforms.
Retail platforms.
So like BT Wrap and Macquarie and all those sort of things.
Yeah. I'm not too
little
sure
plug
the
for
names,
those,
but we're on. So just go to your investment advisor, and we'll be set you.
And how have the funds performed? They sound like they're doing pretty well.
Yeah, our fund makes over 40 basis points per year over the last 10 years, so it's been doing pretty well, pretty consistent, at a lower volatility than other funds.
Okay, so when you say made 40 basis, what you mean above the benchmark, above the
benchmark?
So it wouldn't be like 0.5%. It's over whatever the cash rates were at the time.
Whatever the benchmark was providing.
Okay, and all the rating agencies or the Morningstars and people like that, they recommend you guys?
We're pretty highly rated by the 5 retail consultants as well. We were Money Manager magazine's Fund Manager of the Year in the fixed income space.
And have you got much money? Not you personally, I know you're.
Well, Tyndall actually runs is 23 billion house, and under fixed income we've got 17 billion, so it's a fair amount of money.
Wow. And how's business with Ords in terms of how are your customers going? It's been I was at I don't know how this happened, but I was at the ASX Awards with you, and we were sitting there, and I kept turning around and saying, I'm fixed income, but get in the seat, shut up, talk.
Talk about equities.
It seemed to be a joyless recovery to some extent. How's it been for your clients? How are they performing, if you like?
Yeah, well, I suppose from a retail investor's perspective, some of them felt they missed the boat when the markets sort of take off, so some people sort of got in it a bit later. But look, our model portfolios have performed quite well. Just this month, our growth portfolio outperformed the ASX 200 accumulation by about 5%.
Right.
And that's been fairly consistent, except through the GFC, we had that big dip and rise. So
it's a very big dip.
Yeah. So we've cycled out that negative underperformance, but retail investors tend to focus on individual stocks, where you got to sort of look at the bigger picture and look at your overall portfolio, how it's performed, because there are some stocks in there that are probably struggling a bit. You look at United Group, which is a stock we've liked for a long period of time. They've had downgrades and the share price has fallen quite considerably, but overall the portfolio has performed very well.
And has it been such that the fund managers you think are doing better? How do people, let's talk about your business very quickly because we're about to go to a break, but how do people get money into Ords? Is it they have to know you, or can they get on platforms as well? Or?
It's an advisor-client relationship.
So they just have to know somebody at Ords or look on the website?
That's correct, yeah. We deal directly with retail clients, wholesale clients, and some institutional clients as well.
We have to go to another short break. We'll be right back, where Francesco and Roger will be talking about their Black Swan events. That's very exciting, so stay with us. We'll be back. Welcome back to Your Money, Your Call. I'm Mark Todd, and Sneezy and Francesco Distratus, and Roger from Tyndall, Roger Bridges from Tyndall. They're here to take any of your calls, so please call on 1300 30 34 35. And we've got an email that's come through, and it's Daniel from Perth. And Daniel would like to write... Why are we hearing that rates are going up when it seems to us that the RBA is suggesting that rates should keep going down to keep the Aussie going down? Sorry, I had to ad-lib there. Daniel's point is we're hearing rates are going up, but the RBA seems to want rates to go down because of the currency. What's your thoughts on the cash rate?
No, I think it's just a bit more than just the currency. I think it's the overall economy. The concerns in our local economy are, I suppose, the big concern is that the capital expenditure in the mining sector is starting to taper off, and where is that investment going to go, or how are we going to make up that economic growth? And they're trying to push that across from the mining sector into the construction sector. So that's why they're bringing rates down. Around the world, yes, places like US, they're talking about sort of easing, quantitative easing, but they're not talking about putting rates up just yet. I think that's a fair way away.
What are Ords' view on rates? Do you see another cut this year? Or?
We see another cut in November, but that sort of analysis was done, I suppose, prior to the dollar coming down to where it is now. It was coming down at the time, but at these levels, I still think the RBA will probably tick it down another 0.25% in November. I think they'll just start to look at data points to see how investment is starting to improve in the construction sector.
What about you, currency, and answering Daniel's question? I mean,
well, our view is that rates are probably on hold. The fall in the currency has probably helped, sort of taking that probability away than cutting rates. But at the same time, there's a lot of uncertainty. If the economy doesn't rebalance quickly enough, or unemployment goes up, which it could do, then you will see further cuts in rates. Well, I can guarantee you won't see rises in rates.
You're definitely not going to see a rise in rates. It's just in the medium term. So what's your duration for medium term? Because I don't think you see a rise in rates in 2014.
I tend to agree. With the bond market now having sold off and the 10-year bond actually giving you a return of nearly 100 basis points above the current cash rate, which we haven't seen in a long time, is actually probably looking quite good value. Yeah. But it obviously depends on what happens in the US, but there's a lot of uncertainty out there.
For the viewers at home, Roger's talking about the 10-year bond rate at the moment is about 375, give or take. It'll move around 375, 378. If the Australian government has got debt in 10 years at 378 and the Spanish government has got debt in 10 years at 450, you don't even have to toss the coin to work out which one you buy. Because one economy's got 25% unemployment, structural problems, it's very, very tough. And the other one is Australia. One can play soccer or football. I know you're a footballer. And the other one has got to the World Cup.
And we're AAA rated.
We're a AAA rated entity with a very strong economy, 5% unemployment, good growth. Let's say, I don't want to bring the politics in it, but the opposition would say that we're terrible and the government would say we're not. But essentially, if you write it down, we're fine. And so if we're 375 and they're 4.5, PIMCO is going to be saying, I know which one I need to buy.
Exactly right. And just the uncertainty at the moment in the bond market caused by Bernanke's statement.
He's sneezing. He blinked.
He blinked.
He didn't say he was doing it. He said, we're watching it. I might do something if the economy improves. And it always bemuses me to see. Well, I know the equity markets are going to react, knee-jerk reaction, because ultimately the equity markets are always trying to look 6-12 months ahead. And I'm not sure about you guys in the bond market.
Bernanke's like my 10-year-old. I say, do your homework, and he says, I will. But it should have been do your homework now, because he will, but it's at his own time. And Bernanke says, I will do something, and he makes it sort of, we don't know when. And he's saying, well, when this happens and when this other wheel works, and that's when it'll happen. And that's created real confusion in the markets around people trying to act on it. Whether it be guys looking to sell the 10 years, is this a good time to buy? You've created a lot of volatility over a very short period of time.
And it's been very stable for 6 months.
It had been so stable, you'd be thinking that's where it's going to be.
Look, I agree. You bring back that back locally and look at every first Tuesday of every month, how many brokers are sitting in their screen watching to see what the Reserve Bank does, and really they should be, I think, providing a little bit more stability in our market. Not necessarily for the markets, but more for business to say, well, I know what I'm up for over the next 12 months. I can lock in a rate, rather than, well, I've got to sit back for 12 months because I don't know where rates are going to go. And that's what business want. They want certainty about what they're going to pay for their money.
One of the themes that we've had on this show has been rising above the noise. We've talked a lot about China, Japan, United States, Europe, locally the interest rates. We don't know where they're going. Compare us to the rest of the world. I'm always telling customers, you've got to try and rise above that noise and work out a strategy around having a diversified portfolio that says, I won't be hurt by all the movements. The fastest growing segment in the market of the investment market is self-managed super funds. That's the big one. How does Ords approach those clients, those customers, from an education perspective? Because you could drown them in paper. How do you get to them and get a simple message around?
There's no simple message around super funds, unfortunately. More so from the strategic point of view of, can I put money in? How much can I put in? How much can I take out? That, and the government always is changing the legislation on that, and everyone's got to keep up with it. But from an investment perspective, look, it comes back again to diversity and what stage they are in their super fund. So, if you've got a young person in accumulation phase, you're going to probably look more for growth assets. And you're not punting on speckies. You're looking for good quality companies within the self-managed super fund, but you're looking for growth because you're not going to be able to touch that money for another 40 years or so, and probably by the time we're ready to retire, they might even push it out to 95 before you can touch the money.
Volatility's irrelevant in that context.
So, exactly. But you're looking for quality companies that'll be, they've been around for a long time and they continue to be there. And obviously you've got to have that diversity. You've got to have your fixed interest component. You've got to have your property components within there as well. And then you look at people that are getting closer to retirement, and you remove a lot of that growth element there, and you'd weight more into your income side of the portfolio. So fixed income, equities that are more focused on yield.
No, you've got to write first on fixed income.
I said first, yeah.
That's full stop.
You're still going to have that diversity, though.
What about yourself? How about the education piece for Tyndall? How do you go about it? And I've got to stop losing that.
We've done a big job of trying to educate people. The people don't really understand fixed income. In fact, even our equity people don't understand it. But it is quite complicated. I don't blame people not really understanding it. It's not something taught in schools or things like that, but we've done a big education piece. But one thing I think is the Australian market has underweighted fixed income and lost out on the big bull market. But as we age, they're going to have to look at it as a risk mitigator between your equity portfolios.
100%, yeah.
Speaking of ageing, we talked about it before we came on the show. Japan ages, China ages. This is a phenomena that no one truly understands because it's never happened. When you talk about Japan, and you could say, in 30 years' time there might be 20 million less people, or 50 years' time there might be. These are massive numbers that people don't appreciate. How do you see this sort of playing out? Abenomics, all that sort of stuff. But how do you see Japan 10, 20 years from now?
Well, our Nikko AM is obviously in Tokyo, and they're quite bullish on Japan. They see that there's a lot of political will to try and get it to drive it up. But my question would be: is aging population too much on the headwind?
Yeah, can you cure the ill patient?
Can you actually cure the
But I also think in Japan there's a cultural thing where they tend to be more savers than we have been in, say, Australia and other Western countries.
They're now definitely ages.
But the ageing is an issue. I mean, you've got to look at Italy, the pension problem over there, and Greece and that, where pensions start at 50. When people were dying at 65, that was fine.
So I get a pension in 10 years' time. We'll be back in just a moment with our final segment with Roger and Francesco, and they'll talk about the black swans we didn't get to before. So we'll be right back. Welcome back to Your Money, Your Call. I'm Mark Todd from FIG Securities. I have Roger Bridges from Tyndall AM with me, and I have Francesco D'Estradas from Ord Minnett. Let's talk about the black swan. The idea for the viewers, the black swan this is an ironic question because if they answer it, it isn't a black swan, but the black swan is the things you don't know are about to happen. So, you can be hit by the bus when when you're in the park. What's the black swan in the Tyndall
my
playbook?
theme, as I said to you before, it's like my MG. We keep on fixing things, and you fix the MG, and suddenly something else goes because it's too much strain on the system, and that
British engineering's finished.
It's just a 35 or 40-year-old car, so suddenly will go. But we keep on trying to fix things, and every crisis we've had is related back to a past crisis, and you go right back to the Asian crisis, and they've all been related to. And we then got low interest rates, and of course fundamentals, the
Yeah.
bubble, housing bubble in the US. Now we've got this massive thing of quantitative easing, and the black swan I can see is what is going to be the consequences of not just taking it away, but what is the unknown consequences
Yeah.
of this massive monetary
Because
priming.
it's not clear to me how they can get out of it. And the sugar hit that we talk about, I understand the irony, but we just can't seem to get rid of it. I don't know how to. You're right, crisis to crisis to crisis.
Yeah, and that's
That's the
my
problem.
worry.
What's your black swan?
Well, that's one of them.
You got more than one?
Yeah, well, you've always got to have
Depressing.
your eye on the prize, so to speak. But there's always Europe in the back of my mind as well. It reappears or re-emerges every 3 to 6 months. It has done in the last 12 months. So what concerns me is that we see something not quite right in Spain or Portugal, Italy. Some of the larger countries. Cyprus was to me non-issue, but see how the markets reacted, particularly equity markets. That's a concern for me. The China banking system, the China lending system is a bit of a concern for me as well. But I'm forever the optimist. I think the policy makers, as you mentioned, you say that they should leave things alone. I tend not to agree with that. I'd rather
want to get them involved.
Yeah.
While I've got you, then, what do you see as good value? What's the thing that you'd like to look at? What's the low-hanging fruit? You think that's the one you should be focusing on? What's the positive?
We've been focusing on the LNG sector. It's been under a lot of pressure over the last couple of years for a couple of reasons. One, the US, supply coming on board from shale gas. We think that's probably a bit overdone. And capital expenditure blowouts. Well, some of these projects are starting to get closer to completion, so that risk of blowouts has become less and less. So companies like Santos, Allsearch and Woodside, I think are good value at the moment, and it probably won't play out for another 12 months, but I think we'll see some really good value there.
Good value? Where is good value?
In the bond market, it's very hard to find, but obviously, I think
This is a bond show.
Yeah,
So, what do you mean? We've got to have good value.
but, the state
Why am I
governments
Sydney
obviously.
Airport?
But the one thing is, though, you've got to hold bonds to diversify, and given the types of things we're talking about, there's risk out there, so you have to have a diversified portfolio.
With some of these sell-offs, though, you're going to get some regional, very attractive bonds in the 6% for some of those annuities. That's 500 quarters. I mean, they're just. I mean, I know you've got to deal at the much macro level, so you've got to buy billions of the thing at 23 billion, and you've got half. I get that, but for mum and dad in Australia to buy $50,000 of something that gives them a 5 3/4, 6. Qantas is now 6%.
Yeah, but there are some good value out there, but the trouble is if real rates go up, then you will suffer so
Well,
long
my
as they don't
inflation
go up
linker,
too
Roger,
far.
I've been telling everyone, inflation-linked bonds in Sydney airports, I think is trading around about 4.5% plus inflation. You should do that, PA. I'll sell both you boys. Look, thank you so much. That's all we have time for tonight. Thank you very much to our guests, Roger Bridges, Head of Fixed Income at Tyndall AM, and Francesco Destradas, the Investment Advisor at Ord Burnett. I'm Mark Todd from FIG Securities, and thank you to all the viewers for the calls and the emails. Next time, we'll see you next Friday.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment